Okay, so you want to own a marina. Beautiful waterfront property, boats rocking gently in the slips, yacht owners handing you a check every single month just to park, fuel dock out front, maybe a restaurant with a sunset view, a ship's store stocked with gear people actually need. The water does the selling for you. Nobody walks past a working marina and thinks, that looks hard. They think, that person owns the waterfront. That is genuinely what this looks like. That is the picture. Recurring revenue, appreciating real estate, lifestyle asset, beautiful location. On paper, it is one of the cleanest business models you can find on the water. Here is what the water does not show you. The dock your first big tenant is sitting on is 22 years old. Marine-grade treated timber has a useful life of roughly 25. Replacing one-finger pier runs between $150,000 and $400,000 depending on materials and access. You have 14 finger piers, and the previous owner knew every single one of those numbers before he called the broker. Some marinas genuinely make money. Some marinas look profitable for years, while the infrastructure underneath them quietly crosses the point of no return. And some marinas destroy people who bought a waterfront dream and got a marine construction bill they never saw coming. By the end of this, you will understand exactly which kind you are likely to buy, and the one mechanism that determines which side of that line you land on. So let's start with what a marina actually is, because there is no single thing called a marina. At the basic end, you have a wet slip facility. Boats float in the water, tied to docks, year-round or seasonal, paying monthly or annual lease fees. This is the version most people picture. It is also, in many markets, the lowest margin version of the business. Then you have dry stack storage. Boats are lifted by a forklift, stacked in a covered or open structure, launched on request. No dock to maintain for each boat. Higher density per acre, faster turnover, completely different capital profile, and a completely different customer. Then you have the full-service boatyard. Haul-out travel lift, bottom paint, engine work, fiberglass repair, winter storage on land. This is a manufacturing facility that happens to be next to water. The most profitable marinas, and this is not obvious from the outside, are usually the ones that run 2 or 3 of these models simultaneously on the same property. A wet slip marina with a dry stack barn and a working boatyard is not 3 businesses. It is one business with 3 revenue streams, sharing the same waterfront, the same staff, the same fuel dock, and the same insurance bill. Here is the thing that reframes everything that follows. A marina is not a hospitality business that happens to have boats. It is a marine infrastructure management company that also sells fuel and rents slips. Every number you are about to hear only makes sense once you understand that distinction. Getting in costs more than the listing price. It almost always does. A small single-basin marina in a secondary market, say inland lake, 100 wet slips, no boatyard, basic fuel dock, trades somewhere between $2 million and $6 million depending on region, condition, and lease structure. A coastal marina in the southeast or northeast, 200 slips, working boatyard, dry stack capacity for 300 boats, fuel dock doing real volume, you are starting at $8 million, and the ceiling is well above $20 million for anything in a competitive waterfront market. Safe Harbor Marinas, which now operates well over 100 properties across the United States, paid an average of roughly $30,000 per slip across its early acquisition portfolio. Read that number once more. $30,000 per slip before a single boat is in the water. Then, the financing. Marine commercial lending is not like commercial real estate lending. Lenders who understand marina operations are a short list. SBA loans are available, but cap out at $5 million for most structures. Conventional marina lenders, Bank of the Ozarks, Live Oak Bank, specialty marine divisions at regional commercial banks, will typically want 25 to 30% down on a stabilized marina, more on anything with deferred maintenance, and they will send their own inspector before they commit to anything. That inspector is looking for one thing above all others: the condition of the below-waterline infrastructure, pilings, seawalls, dock framing, electrical systems running through the water, because this is the inherited trap that does not appear on the seller's P&L. A marina can show 3 consecutive years of solid net operating income, while the pilings that hold the docks up are silently losing structural integrity. Wood pilings in saltwater face marine borers, organisms that literally eat the timber from the inside out. Steel pilings corrode, concrete cracks, the dock walks fine, the boats stay put, the slip fees keep coming. And then a Category 1 storm hits the basin at the wrong angle, and 3 docks that looked serviceable become a $2 million insurance dispute and a marina that just lost 40 slips of revenue overnight. That is the trap. You do not buy the business. You buy the infrastructure, and then you find out what it is worth. Now the revenue side, because there is real money here. The question is always where it actually comes from. Wet slip fees are the foundation. A 40-foot slip in a competitive coastal market runs anywhere from $800 to $2,500 per month. In premium locations, South Florida, Newport, the Chesapeake, rates push higher. A 200-slip marina at 90% occupancy generating an average of $1,200 per slip per month is doing roughly $2.6 million a year in slip revenue alone. That number looks strong. Remember it, because we are about to complicate it. Fuel is the second layer. A marina fuel dock doing real volume, 1 million gallons a year, is not unusual for a busy coastal location. Generates margin in the range of 30 to 60 cents per gallon after supplier costs and card fees. That is $300,000 to $600,000 on a 1 million-gallon dock. The capital cost of the fuel infrastructure, underground storage tanks, dispensing equipment, environmental compliance systems, runs $500,000 to over $1 million to build new. But once it is in, and it pulls customers who then rent slips, buy ice, use the pump-out station, and book the boatyard. Dry stack storage is the third layer, and this is the one most buyers underestimate. Monthly dry stack rates for a 25-foot boat run $300 to $700 in most markets. A barn holding 300 boats at $450 average is doing $1.6 million a year in storage alone. The forklift operators, the launch scheduling, the insurance on the structure, those costs are real. But the capital per square foot to build dry stack storage is a fraction of building new wet slip docks. And the infrastructure does not sit in salt water. It does not rot. It does not get eaten. It does not need to be replaced every 20 years. The boatyard is the fourth layer, and this is where the margin conversation gets interesting. Bottom paint on a 35-foot boat runs $1,500 to $3,000 for parts and labor. A travel lift haul-out, which takes 20 minutes, bills at $12 to $18 per foot just for the lift. A marina doing 400 haul-outs a year at an average of $500 per haul is generating $200,000 before a wrench is turned. Skilled marine technicians bill at $110 to $180 per hour in most coastal markets. The boatyard is not glamorous. The boatyard is often what actually keeps the lights on. And then, the number that looks like everything is fine. Occupancy rate. 95% occupancy sounds like a healthy marina. It is not the number that determines survival. The number that determines survival is the ratio of current operating income to the deferred capital expenditure sitting underneath the docks. A marina at 95% occupancy on infrastructure that is 8 years past its replacement window is not a healthy business. It is a business that has been quietly spending its own future. Running a marina costs more than people expect, and the costs arrive on a schedule the income statement never shows you clearly. Labor is the first surprise. A 200-slip marina with a fuel dock, a boatyard, and dry stack storage does not run on 2 people. You need dockhand staff for launches and tie-ups, fuel dock operators, a harbor master or dock master, marine technicians if you run a boatyard, and administrative staff for slip contracts, billing, and the regulatory paperwork that never stops coming. A realistic payroll for a mid-sized full-service marina runs $600,000 to $1.2 million per year. Insurance is the second surprise, and it is the one that tends to genuinely shock first-time buyers. Anti-fouling paint residue, sewage pump-out compliance under the Clean Water Act, and in many states, an environmental site assessment every time a property changes hands. An unexpected fuel release from an aging underground tank, the kind the previous owner assured you was fine, can generate a remediation bill starting at $200,000 and climbing depending on groundwater migration. The EPA has exactly no sympathy for the fact that you just bought the place, and then the fragile mechanism that holds all of this together or blows it apart, the infrastructure replacement cycle. Wooden docks and saltwater last 20 to 25 years under good maintenance conditions. Aluminum docks last longer, but cost more to build. A full dock replacement, not renovation, replacement, on a 200-slip marina runs between $3 million and $8 million, depending on materials, access, permitting, and whether the seawall behind the docks also needs work. That cost does not arrive gradually. It does not show up in your monthly P&L as a slow bleed. It arrives as a bill, or as a storm, which forces the same decision faster and under worse conditions. Operators who defer that replacement to protect short-term cash flow, shrink their leasable capacity, lose their largest boat tenants to marinas with newer docks, reduce their average slip rate, and enter a revenue decline that looks, from the outside, like a demand problem. It is not a demand problem. It has never been a demand problem. It is a dock problem that became a business problem because no one priced the clock. In 2017, Hurricane Irma made landfall in the Florida Keys as a Category 4 storm and effectively ended the operating lives of dozens of small family-owned marinas in a single night. The ones that didn't come back were not the ones with the worst damage. Some facilities took catastrophic hits and rebuilt within 18 months. The ones that stayed dark were the ones whose owners arrived at the insurance adjustment meeting and discovered their policy did not cover the docks. Marine property insurance in the Florida Keys had been, for years, structured in a way that many small operators did not fully understand. The dock infrastructure, the pilings, the finger piers, the gangways, was classified separately from the upland structure and covered under a different policy form with different sublimits. Owners who believed they were fully insured found that their dock replacement cost was either partially covered, subject to a separate, much higher deductible, or in some cases not covered at all because the docks had been flagged in prior inspections as showing deferred maintenance. An insurer does not pay to replace what was already failing. This is the moment where the infrastructure replacement clock and the insurance structure meet and destroy someone who didn't know either one was running. The operators who came back quickly had two things in common. First, they had maintained their docks on a documented replacement schedule, which meant their insurance claims were clean, defensible, and covered. Second, most of them had either institutional backing or access to credit lines that let them bridge the gap between the insurance payout and the full reconstruction cost. Safe Harbor Marina, the platform that had been quietly acquiring distressed and aging marina properties across the Southeast throughout the preceding decade, emerged from the 2017 storm season in a structurally stronger position than most of the independents they competed with, not because their facilities were undamaged, some weren't, but because they operated across a portfolio of more than 80 locations at that point, which meant no single storm event could threaten the platform's solvency. A family operator whose one marina in Cujo Key took $1.8 million in dock damage and got $600,000 from the insurer was facing a $1.2 million gap on a business that generated $400,000 a year in net operating income. The math on that gap is not complicated. Safe Harbor, facing the same damage event at one node of an 80-location network, absorbed the gap, rebuilt faster, and in several cases acquired the adjacent independent that couldn't. That is not a story about a hurricane. That is a story about what the infrastructure replacement cycle actually costs when you cannot spread it across a portfolio. The family operator had not done anything wrong. They had run a clean operation. The docks had been maintained reasonably well. But they owned one marina. The storm arrived on the wrong schedule, and the insurance structure that they had trusted for years turned out to be a different document than the one they thought they had signed. So who actually makes money in this business? The honest answer is that the economics of marina ownership almost perfectly reward scale and almost perfectly punish isolation. The large institutional platforms, Safe Harbor, Suntex Marinas, Marinas International, Loggerhead Marinas, are buying marinas not primarily to collect slip fees. They are buying waterfront land with a marina operating business on top, and they are underwriting the deal on the real estate value as much as on the operating income. In markets where waterfront land is genuinely constrained, and in most of coastal America it is, the land under the docks appreciates whether or not the operating business performs. The slip fees pay the carrying costs, while the underlying asset builds value independently. The tax structure matters here in a way that is genuinely underappreciated. A marina that files as a qualified opportunity zone investment, and many coastal redevelopment zones were designated as opportunity zones under the 2017 Tax Cuts and Jobs Act, defers capital gains on acquisition and potentially eliminates them on appreciation if the investment is held long enough. The individual buyer paying full capital gains on a sale that took 10 years to materialize is competing against institutional money that structured the same investment to pay a fraction of that tax rate. That is not a metaphor for an unequal playing field. It is the actual mechanism by which the field became unequal. The second class of people who reliably profit from marinas are the ones who buy broken ones. Not operationally broken, structurally broken. A marina where the previous owner ran out of runway before completing the dock replacement, priced correctly for its current condition rather than its potential, bought by someone with the capital reserves and the construction relationships to complete the cycle that the prior owner couldn't finish. That acquisition, in the right market, generates returns that a fully stabilized marina almost never produces. The upside is in the gap between what deferred maintenance costs to fix and what stabilized operations the fixed marina is then worth. A realistic good year for a well-run, fully stabilized, full-service marina in a strong coastal market, 200 wet slips, dry stack capacity for 250 boats, working boatyard, active fuel dock, looks something like this. Gross revenue of $4 to $6 million. Net operating income in the range of $1.2 to $1.8 million. A cap rate somewhere between 6 and 8% on the acquisition price, and a property that has appreciated 15 to 30% over a 5-year hold period in a constrained waterfront market. That is a legitimate business. That is real money. A realistic bad year looks like this. A named storm makes landfall within 50 miles of the marina in mid-September, which is peak revenue season and also peak hurricane season, because those two calendars overlap exactly and always. The dock assessment comes back at $1.4 million in damage. The insurance adjuster applies the deductible, argues over the pre-storm condition of 2 of the piers, and cuts a check for $740,000. The marina is partly closed for 4 months during the reconstruction, which happens to include the fall storage revenue window. Net operating income for that year, roughly 0, possibly negative. And the loan payment is still due every single month, regardless of what the storm did to the docks. What determines which year you live is not the quality of the marina or the strength of the market or how hard you work it. It is 3 things. The condition of the infrastructure when you acquired it, the precision of the insurance structure you put in place before the season, and whether your capital reserves can survive the gap between what the storm costs and what the policy covers. The uncertainty that remains, the honest one, is the storm itself. You can price the infrastructure. You can build the reserves. You cannot price the calendar. A marina is not a waterfront lifestyle business that happens to generate income. It is a marine infrastructure company that happens to sit on some of the most valuable, most constrained, most irreplaceable land in the United States. And the gap between those two descriptions is where people lose fortunes and where other people build them. The fantasy is real. The waterfront is real. The revenue is real. What the fantasy does not show you is the dock clock. The silent replacement schedule running underneath every slip, every piling, every finger pier from the day you sign. The buyers who understand that clock before they close are running a business. The buyers who find out afterward are managing a crisis on beautiful water. Know which one you are before you make the call.